Good morning. It is Friday, July 20th. This is Kirk Spano's Fundamental Trends and also Margin of Safety Investing. And so let's start with a definition of a word. I wrote the word belie in an article, and apparently I didn't use it perfectly, and two word police decided that they should inform me as to what it means. Belie, of an appearance, failed to give a true notion or impression of something, disguise or contradict. Fail to give a true notion or impression. So I said, Fed Chair Powell's insistence to raise interest rates belies a complete lack of understanding of the slow growth forever world I have described before. And we should probably talk about that today. Free flowing. Well, so I guess the right way to write this sentence would have been Fed Chair Powell's insistence to raise interest rates belies an understanding. Double negatives here. End up going in a circle. So, okay. So it wasn't using belies that was wrong. It's what I put out after it. Belies an understanding. Contradicts an understanding. Yes, I think that would be it. All right. So be careful if you ever write an article and you hustle through the editing because the word police are out there. Be careful. The word police are out there. All right. So we talked about this last week, that I believe it's time to be a net stock seller. And that doesn't mean I'm running for the hills. It doesn't mean that I'm going 100% cash. It doesn't mean that I'm buying gold. And we're going to talk about gold because I had a pretty interesting exchange with somebody. Interchange is what's under construction in my city, all of them. But let's talk about why to be a stock seller again and breeze through this. Then let's hit a whole bunch of questions and let's go off on tangents and talk about gold and cryptocurrencies and why they're important. So we did the webinar last week, and I just synthesized it a bit and gave some ideas. Now, I wanted to let people know that we've done this trade before. And I don't like to make these kinds of trades. I prefer to be a position trader, hold things for years at a time, buy and hold 2012 on margin on Seeking Alpha would be proud of me. In fact, find, buy, and hold. There he is, giving me a lecture. It's time to be a stock seller. Kirk, how did this happen? Where did you get the idea that it is ever time to be a stock seller? They say that there is a time for every purpose under heaven. A time to reap, a time to sow, a time for making whoopee. Even Miller time. But there is never a time to sell stocks. Never a time to sell stocks. And never is a mighty long time. But I'm here to tell you, there's something more. Right? Prince. Can't forget Prince. You see, since 1928, stocks have increased in value by an average of 10% per year. So why would anyone swim against the tide and sell? Okay, before I forget, let's pull up Crestmont Research. Bam. Well, we're going to look at a pretty neat chart in just a second. So in any case, also, studies have shown that the most money is made in the stock market on relatively few days a year. Why take a chance and be out of the market on those days? Also, there are what I call super stocks. Stocks like Apple that are worth almost 20,000 times what they were worth in the 1980s. Why would anyone ever sell a super stock under any circumstances? No, it is never a time to sell stocks. In the stock market, there's a time to buy, to hold, and a time to buy. There's never a time to sell. And again, that's a really long time. I agree with you that having cash or dry powder is a good thing, But it is not necessary to sell stocks in order to have cash. I never sell stocks unless I am forced to sell by a cash buyout. And at this time, 20% of my total net worth is just sitting in cash. I don't believe in ever being 100% invested in the stock market. 70% of my total net worth is invested in the stock market, 20% cash, 10% in real estate. That seems pretty rigid to me there, buy and hold. Why do you encourage people to sell stocks, Kirk? Because they're getting dangerous. My mother, who is a much better investor than I am, would not be happy with you. Do you want her phone number? So I have a reply. And it's pretty simple. And I do, in fact, wait in anticipation for buy and hold's responses to me. And I would just point out to him, as usual, you missed the fact that most people are not you, right? Who could be buy and hold 2012? There's only one. Most people can't take a giant correction because they might actually need to spend some of their money in the next decade, right? At least some of that money. So folks who didn't sell at least some part or a large part of their holdings in 2007, give or take, had to put off retirement, right? I talked to these people. I was sitting at their kitchen tables when they invited me over in 2009 and said, Kirk, I lost half of my retirement savings. I have to keep working. I thought I was going to retire in the next year or two, right? So would it be nice if everybody had a pile of dividends that they hadn't reinvested in the last several years? Yes. It would be great if everybody had just accumulated cash up to around 20, 30, 40% of their portfolio because they realized that the stock market's been expensive for several years, so they subdued their buying, right? But most people didn't do that. So when I tell people to sell stocks, I'm specifically telling people, hey, make an asset allocation adjustment. And if you need to get to 20 to 40% cash, and I'm telling people 25 to 40% cash, and you don't have it, and you can't save it up quickly, and your dividends aren't going to accumulate it quickly for you, start to do some trimming. Start with your losers, right? Because we have a psychological problem with losing stocks. We want to hold on to those stocks until they come back, right? I'm just going to hold this stock until it comes back. Now, this stock over here that just keeps going up, I'm going to trim it because it's up. That's wrong. Wrong. Ride your winners. Now, for some people, you'll maybe trim back on your winners. I just sold a whole bunch of Amazon. But for most people, you've got enough losers and dead stocks that if you make a true analysis of the company, right? And I go through this over and over and over again. You have to understand the company and the business. That's hard for people because they don't have time. But if you understand the company and the business and you apply the core 4 method that we use, which is analyze the big secular trends, understand the role and the impact of government and central banks on the company. Now you take a look at the fundamentals, and then finally you take a look at the price trends, technical and quantitative analysis. I prefer quantitative analysis, but technical for intermediate and long-term trends is pretty good too. So if you're not buying and hold 2012, right, he's a superstar because he happened to invest over a really long period of time and made a whole bunch of money. He's 70-ish years old. His mom is in her 90s. That's what she says, or what he says. And I believe him. So I understand the idea that you want to buy and hold. I generally do own my stocks for a long period of time. Exact Sciences. Somebody asked me about Exact Sciences in one of the chats here just a second ago. I don't have much of a Exact Sciences holding anymore. I was a huge bull. I'm the guy who argued with Citron Investments, right? So I bought Exact Sciences, oh man, a long time ago. First bought it in 2008 and 9 for $1.65 is where I really loaded up. I started buying it around $3. And I rode it up and down, and it went up to 16 and back down to 5 and up to 30 and then back down to 6. And then And that last and because it was so volatile, I was able to trade it a bit and just keep accumulating a bigger position because I kept selling puts, and in the troughs I would buy calls. So when Exact Sciences hit single digits last time, I sold as many puts as I could, and I bought leaps. And the stock over the next 18 months went from in the single digits up to 62. And on the day of the high, or maybe I might have been one day off, I was actually sitting at breakfast at Blue's Egg in Milwaukee, 76th and Bluemont. It's very good. If you're in town, you should go there. And I told a guy named Fireman Jim, good friend of mine, subscriber to one of the services, and I help him out. I said, hey, Exact Sciences is spiking right now. Log into your Schwab account and sell it. And man, you should have seen his face over eggs. He's like, what? We're making a ton of money in this stock. I'm like, right, but I told you when it was bottoming. I'm telling you when it's topping. You need to sell about half of your holding right now. And he looked at me, and he paused, and then he did it. And within weeks, the stock was back down in the 50s and then in the 40s a couple of months later. Now, he added a little bit back in the 40s, and now he's ridden it back up in the 60s again. And he actually did sell most of it again into the 60s. So the point is, there is some room for trading, even if you're a long-term investor, because sometimes the easy money is made, and we start to get into the hard money. And right now, Exact Sciences is hard money. Do I think it's going to 100? Yes, I think it's going to 100. Do I think that'll happen imminently? Nope. Next 2, 3, 4 years? Yep. But that's only a 50% gain. What if it takes 5 years to make 50%? I don't like that risk-reward ratio because since it's a biotech, and since everything's an execution story at some point, and since I believe the government is going to come down hard on healthcare at some point, do I want to have a gigantic stake in that particular company anymore? Now, I will tell you, it was 40%, after it grew, it got up to being 40 to 50% of my holdings. Why? Because I bought it to 10, 12, 15% of my portfolio down when it was in the single digits, and the thing went up 600% or 1,000% or whatever the heck it was. Some of the options I made 1,000%. The stock from the very bottom made 1,000%, but my average price only made about 600%. So you say, okay, the easy money's made. Reanalyze the risk reward. It has 50% upside, but it probably has 50% downside. Exact Sciences I'm talking about. Well, a stock that has as much upside as downside, I don't want much of. I might not want any, right? So I have a token holding because I fell in love with Exact Sciences. Even I have a problem with love. So I can't quite get rid of all my Exact Sciences. Should I? Maybe. But I hold a little bit because deep in my heart, Exact Sciences made me so much money that I'll be able to retire someday, but I just don't want to let her go. Not all the way. So now we're friends. In any case, that's how the stock market is. The stock market has periods of easy money, periods of hard money, and in between. And what do I tell members to the service over and over again, to either one of the investment services, and what do I tell clients? What do I tell anybody who listen? Ignore the middle of the market. The in-between stuff in the stock market, it's too hard to trade. Don't deal with it. If you're in a position, just keep it. And if you got something that's going down and it's got a bad trend and your thesis is wrong, go ahead and sell it. But in general, you do want to be a buyer of stocks. But when stocks get very expensive and when we start to see signs of deterioration in the market, which we are seeing in spades, you have to say, okay, what is my risk tolerance? When do I need some of this money? Right? If your answer is buy and hold's answer, which is I'm never going to need the money and I'm just going to die and pass it on, okay, you can go golfing. You're like, yeah, I've accumulated some cash on the dividends because a few years ago I was real smart and I stopped reinvesting it, which I was telling people a few years ago. 2015, I started telling people, stop reinvesting your dividends. Why? I love reinvesting my dividends. It's free. It's easy. I get it. I get it. I've been doing this since I was 18 or 19 years old or something, with internships. I get it. But cash is king. That's a real phrase. It's a real phrase for a reason. It's because it gives you optionality. Do we know about optionality? Optionality. How many of you have read a book by this Nicholas Taleb guy? Oh, which book did he put this in? Oh, Anti-Fragile. Was it Anti-Fragile? Maybe it was Anti-Fragile. So optionality is, I know who it was. I didn't know which book. He's got like 7 of them now. Is the ability to strike when the iron's hot, right? So if the stock market drops 20%, like it did earlier this year, actually I think it went down 19, right? I think I predicted a 19% correction, and we got a 19% correction. And actually I have that graphic. Optionality with cash is the ability to say, well, I have the cash already, and now the stock market's gone down, and people are panicking, and they're saying, oh my God, I want to sell this stock because it went down. Now, you can do one of two things. If you are sitting there next to that person, and they're a friend of yours, you can talk them out of it, right? Because that's the right thing to do. If the stock already dropped 30, 40, 50%, you say, look, man, I understand that you missed the trade to get out, but you know what? Right now, if you believe in that company and you can validate your thesis, right? You can verify that it's going to go back up in the next few years. Maybe you should buy a little extra right now rather than selling at the bottom, right? And I have a horrible story about that. Somebody who sold that ordered me to sell at the bottom, and it didn't go well. So you can try to talk people out of making bad decisions, right? But at some point, all you can do is take care of yourself. So whether your friend or relative or neighbor is trying to sell at the bottom and you get a chance to talk them out of it, that's one thing. But that usually doesn't happen. What usually happens is the stock market sells off, you're looking at it on a screen, and Google is $830 a share. Or Amazon is back down to 1,000, right? These things haven't happened yet, but they might. And if those things happen, you should probably look at the screen and talk to it a little bit like I do and say, you know what? I can feel your pain. I know that you have this horrible, horrible stock that just dropped 30% on you. I'll buy it from you. I'm a good guy. I'll buy that stock from you. Right? So that's all we're positioning to do. The stock market is schizophrenic. It is going to sell off at some point, and if we have cash, we can buy that correction. Now, I'm a pretty good market timer. Oh, yes, evil market timing. Market timing isn't really timing. Market timing, in the sense that I use it, is really market pricing. If you haven't read Nicholas Taleb books, by the way, you should buy a few of them. You can breeze through these in a weekend. They're actually pretty easy to read for being pretty deep philosophical and financial books. But I think that you should read some of these because these are the types of books that hit you in the head and wake you up on something. And I don't know what it's going to wake you up on, but we all need something to be woken up on, and these books are waker-upper books. So, in any case, I think that right now raising cash is a pretty good time because based on what I'm seeing, we are about to repeat with different details what happened in February. So back in December of last year, I told people to start selling because volatility had to rise, and here's why. I explained how these derivative contracts were designed and the whole carry trade that was going on, and I knew it had to crack. I didn't know exactly when it had to crack, so I basically put us on alert in January, and over a course of a few weeks, we bought calls on VIX, and we bought puts on the S&P 500, and a lot of people made a lot of money. And then we've, and it wasn't the whole portfolio. And, it was a few percent of the portfolio. So if we put 6% of our money into this trade and that 6% doubled, that's 6 points into the portfolio, right? So when I put up my first half of the year returns somewhere, maybe here. Ooh, and I got that graphic too. I don't remember. Somebody want to show me where I put this? Preview of next month. Oil thoughts VSL tracker. Was it here? Might have been here. No? All right. Well, we have it in the files. Well, whatever. If somebody can find it and put it up, I'll put it up there. So anyway, we made 14% the first half of the year, and we had about a quarter of our money in cash, right? So basically, we beat the best index, which was the Russell 2000, with a quarter of our money in cash. That's a great risk-adjusted return. And last year, we were able to make 48% with an average of 31% of our money in cash, right? So I post this stuff. This is my composite over at Interactive Program. I manage a lot more money now. I decided to take clients again this year. I hadn't taken clients in a while. While I straightened some things out, got my business back to the way I wanted it, and enabled myself to be able to travel a lot. So those articles, by the way, are coming out, the poker investing in 3 weeks in the desert. So anyway, 48% last year, ended the year with, about a quarter in cash, but our average cash holding last year was 31%. So, this idea that holding cash is going to ruin your return, it's wrong. It's just wrong. Now, you can't hold cash for a very long time. And you can't hold cash when interest rates are zero, hardly at all. So the TINA trade, there is no alternative but the stock market. That trade's ending right now. And you need to understand that trade is ending right now. So if you aren't at 20 to 40% in cash, 25 to 40% in cash, right? Because even buy and hold 2012 is in 20% in cash, right? But he doesn't want you to sell. Well, gee whiz, man. How are you going to get to 25 to 40% cash if you don't sell a little bit? Right? So would it have been better if you just trickled in the dividends and you had just this great portfolio with no losers and there was nothing to sell, but you had still had cash? Yeah. And buy and hold is a superstar, so he was able to do that. I know that a lot of people don't have a whole lot of cash saved up, and to bring their cash holdings, say, from 5% to 25%, you can't do it without selling. So please, take a look at your portfolio, consider your asset allocation, and give yourself the optionality to invest when there's a correction. And I do think there are 4 very good reasons why that could happen. But let's start with market structure, right? Because even when there's catalyst for a downturn, if market structure is strong, meaning that there's a ton of depth in the market and lots of people who will buy the dips, then it doesn't matter. That's when your wall of worry just keeps getting climbed and climbed and climbed, right? Right now, the marginal buyer, the person who was buying on the dips, those buyers are disappearing. And it's happening for a couple of big reasons. The first one is that quantitative easing has basically ended on net. In the United States, it's ended all the way, but even the European Union is pulling back a little bit now. So on net, there's no more quantitative easing on the planet, right? Now, there are pockets of quantitative easing, like in Japan. Maybe China's doing it. We don't know. But on net, there's really no loose free money hitting the market anymore. So when that money, when the Fed printed money, when the Fed did quantitative easing, it's actually borrowing money to move it around. Um, deferring that inflation to a future date. Uh, they gave it to the primary bankers. The primary bankers filtered it into the system. A lot of that money went into assets. The Chinese also were big net buyers for a long time. And I've got a pretty interesting chart here. Chinese foreign direct investment, bam, crashed from 2016 to 2017. And this year it's going to be way down here. It's going to be like 2011. What happened in 2011? There was a correction, wasn't there? Yes, there was. So I think the same thing's about to happen because we don't have the marginal buyer there to buy the dips anymore. So once something triggers selling, there's not going to be a whole lot of people in there to buy. And it's going to be important to be the heck out of the way before that happens. When is that going to happen? Could be Monday. I suspect it's going to be October, November. But I don't know that. I just know that it's all lining up. So why would I try to guess? Why wouldn't I just start to scale out? I have this nice rally that's going on. Raymond James pointed out, Jeffrey Stott pointed out that this buying crescendo that we're having right now generally lasts from 2 to 4 weeks. And we're halfway into that period. So anyway, anytime after I think it was day 17, and we're about to hit day 17 on Monday, I believe it is, the market could turn over. So, and Jeffrey Salt, I made fun of him when he called the new secular bull market back in 2009. So far, he's been right. And if we don't fall below, was about 1,600. If we don't fall below 1,600 on the S&P 500 ever again, then he was right. Then we started a new secular bull market back in 2009. And I think 10 years in, you have to start giving that guy the benefit of the doubt. Now, I thought he was wrong. I did think he was wrong. So how low? The word low. No, low. All right. One of these articles is how low can the market go? How low can the stock market go? Click. All right, so I put in a chart, and I think this is a very important chart, right? So we had the double top of the stock market, crash, tech wreck, real estate boom, and derivatives growth, crash here. And this is where Jeffrey Salt called the secular bull market. And I was like, no freaking way, right? I thought we'd go here, triple top, come back down. But what I didn't fully understand back in here is just how powerful quantitative easing was. So quantitative easing filled the gap in the money hole that we had created. They filled it up. Again, we still have to deal with the deferred inflation someday, but, and something that even Warren Buffett has kind of overlooked, is that the slow growth forever economy, because of the deflationary forces of demographics and accumulated debt and technology with productivity issues, we're probably not going to see big inflation. And I know that there's gold bugs out there saying inflation's coming, hyperinflation. It's not going to happen. It's not going to happen. Why? Because there's deflationary forces, and the biggest impact on the economy is demographics. More people in the market, less people in the market. People at ages where they spend a lot, people at ages where they don't spend a lot, where they just spend out. So it's starting to look like, and I will give credit where credit's due, that we did in fact start a new secular bull market down here. And it's going, and it's going, and it's going. And this is the support level. If we never go below this level again, then in hindsight, we will know that Jeffrey Salt was right, and Raymond James, that we were in a secular bull market. Now, I think it's starting to look like he's right, and I think the secular bull market will have a event. I am the crash 2020 hashtag guy. I think we'll come back down to 2,200-ish on the S&P for sure. And if there's a crisis, we'll see this area down here again. Now, I believe that central banks always come to the rescue. They always have. Central banks also cause some of these problems. So I'm not a big Jerome Powell guy. I think Jerome Powell is, I believe I just called him a dunderhead. Let's see here. Find Dunder. Dunder. Oh, wrong article. Wrong article. Let's find Dunder. Yes. So I replied to somebody, and it occurs to me that Chairman Powell is a dunderhead. So, he doesn't understand the slow growth forever economy. And that is important because that is one of the part of the catalyst, right? So the most important catalyst, and I've got four things that you need to watch. Federal Reserve is number one. Liquidity in the markets, which a number of other analysis firms, big ones, are talking about, is liquidity in the market. And we just talked about that with market structure. So as liquidity dries up, there'll be even fewer and fewer marginal buyers when stocks drop. And we know that earnings are artificially high right now because of the repatriation and the buybacks. So and the low interest rates. As all these things either change or dissipate, right? The one-off tax break for repatriation will be gone, and you'll have the that'll wear off. So they're not going to be able to keep doing these buybacks. And I talked about that in the buyback bubble will end badly, right? So we know free flowing is getting to be burdensome. Bubble. The buyback bubble will end badly. See, they should use that kind of a link. We know that that's probably going to go poorly. So the thing you really, and I bolded this, right? So right now, we have buybacks that are fueled by the tax breaks. And at the same time, the insiders, the executives who are ordering the buybacks, are selling their company stock into it. So the biggest share sales by executives in a couple of years, 8.4 billion of their shares in May, 9.2 billion in June. So basically, the insider executives are using the proceeds from a one-off tax break to buy back company stock while selling their own stock into those buybacks. It's legal, hugely unethical. So if that doesn't wake you up, I honestly really don't know what will. And I say this here. I'm an Italian guy. I've heard stories. I've been places where people talked. The old mobsters called that sort of thing a racket. And it's a racket, right? They're getting money from tax breaks for the corporation and then selling their stocks into a buyback that they control. So, I do want to make that very clear. There is a group of executives who are not only selling out their companies, because they shouldn't be doing the buybacks in the first place, they should be doing more productive things, but they're selling out you and America in general, all to get filthy rich. And when I say filthy rich, I mean filthy rich. They're really just stealing. And this is what happened back in 2007. There was huge buybacks. So with this poor market structure and all these things adding up, if they dry up liquidity, that'll be the biggest culprit. And really 2019, 2020, things look like they get pretty rough. Ben Bernanke mentioned it. Ben Bernanke says, hey, the economy is pretty strong right now, but a year or two from now, you really got to watch out. And he pointed out that there's a whole compendium of things coming together. I may have used that wrong too, but I don't know if there's any word police coming together to a head in 2020. Hence my hashtag Crash 2020, which I started quite a while ago. All right, so I don't know why I'm getting beeping, but here's another thing. what if we really have a trade war? Right now we're flirting with a trade war. Let me throw out a hypothetical example. Let's suppose we really piss off the Europeans, right? Their trade bloc is as big as the United States economy, just like China's is, right? So basically you have three similarly sized economies, China, the United States, and the European Union. What if China, and they don't have to do it together, but what if China, and what if the Europeans finally say, you know what, screw this Trump guy, right? What if they all decide to try to jam it to us? I don't think that that's completely outside the realm of possibility, right? What if China and the Europeans hold a summit? What if they have a meeting and they decide to work closer together and put the United States a little bit more at arm's length? What if that happens? Right? Somebody should be saying in the chat right now, it actually just happened. It did. They just got together. What do you think they're talking about? I don't think it's nice. I don't think they're very happy with us. They're big too. So all this brinksmanship, at some point, when do you push a bully back? And right now, President Trump is being a bully. And I'm not saying he's wrong about everything. I don't think he's wrong about everything. But the methodology is probably wrong. And the reality is that we're not that strong anymore. We're not half of the world economy anymore. We're not 67% of the world economy anymore. We're a little over 20%. So while we have incredible geographic, structural, legal, technological, labor advantages to really everybody else in the world. We do. We naturally have and will always have the best economy in the world. I'm pretty convinced of that. That doesn't mean we'll always grow the fastest, but we have the best national economy in the world as long as we don't screw it up. So, if there's a real trade war, that could be significant. It can knock a few points off of GDP for a while, and that's bad for everybody. Now, what if there's an oil shock? What if the Iranians, which the sanctions are supposed to be in full force in November, what if the Iranians say, you know what, just had enough of this? And what if China enables them a bit? What if China says, yeah, you can send most of your oil and gas over here? I think that could happen. And then what if the Iranians, just to screw with the rest of the world, they throw a couple thousand mines in the Straits of Hormuz and shut it down for a month or two? Right? What if? I think that these are not things that are far outside the realm of possibility. These are not, 1 in 1,000 chances. I think these are coin flips, right? These are just about coin flips. And I have learned in poker, you want to avoid coin flips, unless you have to take a coin flip, but you really don't want coin flips. So, and then in November, we have the elections. What if the Democrats, who are leading in all the polls pretty much, start really knocking out a lot of Republican Congress people? Do you think the Republicans that are left are going to be quite as aligned with President Trump after that? What if the Republicans, and there's a lot of them talking, Corker's out there, I think he's a Republican, Corker and a bunch of other people are already calling President Trump to account for just the way that he does things. What if the Republicans and Democrats work together a little bit to fight President Trump? What if there's gridlock? What if there's a three-way fight? So, again, I'm not trying to get anything to happen. I'm a speck of sand in the universe. But I can read the tea leaves pretty well usually. And I think, and I can be wrong, I'm wrong all the time, ask my ex-wife, I think that there's a good chance that a lot of these things happen. And I think the liquidity issue, which is probably the biggest one because it's the most certain and it's the best indicator, is probably most likely to happen. So we have to be careful. And at what point does the market anticipate these things, right? Does the market wait until these things happen to sell off, or does it anticipate it? Market's pretty anticipatory sometimes. So again, raise some cash, okay? I do want to show you a chart from Crestmont Research. If you get a chance, go to Crestmont Research. Awesome. That's the chart I want. Website. And they talk about secular stock market cycles. And what you'll see is that there are very long periods of time, even though the stock market does in fact average about 10% over time with dividends reinvested, I believe that is what that number is. You have long periods of time where the stock market doesn't make much, right? So you get a whole decade here where the market is actually down. But if you take a look from 1929 all the way out to 1940, 11 years and the market's still down. And if you go straight across, nominally, it was 20 years. The market didn't make any money. Look at that. I mean, they could have, they broke it out in the cycles. But what if they had gone from peak to trough? Look at that, 20 years to make that money back. Then you had the 1970s. Look at that, almost no money for a decade. So, wrong one, yeah. So what do we have here? Now, I think Crestmont is wrong. I think I'm convinced. I'm not 100% convinced, but I think that, take a look at this. We are probably in from this point here, from right here. I think that this should be red. And I think that from here to here should be green, right? I think they're going to have to change these colors. So from 2009 to now, I think we're in a new bull market, right? But from here to here, for those 9 years, no money, right? From here to here, if you had cash, if you had been at one of my seminars in 2007 where I was buying people steak dinners and telling them to sell real estate and sell stocks, and they were telling me I was crazy, and more people fired me than hired me, if they had done what I told them to do here and then bought back down in here, they'd have done really well. And I'll just give you something that actually happened. So I worked at a firm, and it's a much bigger firm now. I helped as one of the first reps, there. And it's a great firm, and they've made huge improvements to their systems and how they do things. But we had switched to TD Ameritrade as a platform in 2009. And we had a meeting in January, February 2009 where they pulled up a screen that showed everybody's aggregate return for 2008. And there was a whole bunch of negative 30-something, negative 40-something, negative 50,000, 50% across the reps. Well, my name is Spano, right? S. So you get negative, 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 negative. Then all of a sudden, Spano, 12%. How the heck did that happen? Well, I will say I didn't make 12% across all my accounts, only my TD Ameritrade accounts. Because the TD Ameritrade, I was buying an SKF, I think it was, an ETF that went up triple what the banks went down. So I was heavy in cash. So I'm heavy to cash. I had Fidelity accounts too, and I actually bought a bond fund, and the bond fund got creamed too, which blew my mind. So I thought I did the right thing by going to some bonds over at Fidelity, and their bond fund got creamed. But the cash in the brokerage accounts, plus SKF, we made a whole bunch of money. So I was actually positive in the managed accounts in 2008. And then we were talking, and you had the people who were like very anti-President Obama at the time, and they're like, President Obama's going to ruin the economy. And my point was, hey, isn't the economy, and this is February of 2009, my point was, isn't the economy already ruined? Right? Didn't we already wreck it? So you need to look at things through a lens of reality, not ideology. The economy was already wrecked in the first quarter of 2009, and they were doing shovel ready, right? They were doing the big infrastructure projects for $1 trillion. You're still seeing that money filter into the economy. It's actually just finishing up. So that's actually another catalyst for things to go down. All the gigantic highway and bridge and all these other projects that were funded in 2009, And those are basically over this year and next year. So keep that in mind. That's a lot of construction money that's not out there, and I'm not sure it's all getting replaced. So 2009 first quarter, people are saying, well, President Obama's going to wreck the economy, but he's doing $1 trillion, and him and Congress are doing $1 trillion spending project, and the Federal Reserve comes out and says, we're just going to do whatever we have to do to pull us out of this. So the president and the Federal Reserve are both saying, we're going to do whatever we have to do to get out of this. We're not going to have a depression, right? Austrian economists hate that because they're like, let the system wash out. Well, everybody else is like, well, dude, don't ruin my life. Fix it. We'll deal with the bill later. Just don't make me live in a depression for a decade. So that's what they did. And in March, my dad and I sat down and, said, hey, we should probably start buying stocks. Right? President Obama gave a speech, said, hey, if I could buy stocks, I'd be buying stocks right now. When the president of the United States says I should be buying stocks right now, you probably buy stocks. So, funny story. The current president of the United States sold all of his stocks a couple of years ago. Didn't say nothing, but he sold all his stocks. Did you know that? I think that's pretty important. And the Trump family sold all kinds of real estate. Interesting, right? So they're a brand company now, but they're not really a real estate company anymore. They've sold tons of real estate. Why would they do that? What do they know? What are they trying to achieve? I don't know. I know that they opened a media company that they had to put on ice when they won the election. So you need to think these things through, because if you can get over ideology and just look at the facts, what you're probably going to come up with is what I've been coming up with, which is we're entering some really dangerous times. And people have been foreshadowing it for years, and they jumped the gun. I don't like to jump the gun because I know that you should be biased to being long the stock market most of your life. But every now and then, you run into a period where you should be a seller. And I think that's where we are right now. All right. Let's do some questions. There are a lot of them. Holy cow. All right. We are 47 minutes in. So you can get this done in 8 minutes. Micron. I love Micron. I think Micron's going higher. However, I think the market is choppy. I think that I want to own a little bit of it, but not a lot. And I'm looking for an opportunity to buy calls if it gets cheap. Okay. Thank you, Nitschke, for agreeing with my grammar correction. More word police. Thank you for the word police. Thank you for your service. Certain leaps. I mean, I don't know what leaps you own, but I only own a few leaps, right? So I own some leaps on energy, some leaps on Nutrien, because I think Nutrien is got very little downside, and ultimately could really see a huge rally at some point, especially if there's drought for the next year. But in general, yeah, I'm not selling puts right now. This weekend, I'm going to put out the list. I'm going to combine the July and August stock and option lists, and we're going to focus on about 20 companies. And we're going to look for opportunities, and it may not come in August or July. It might not come till September, October, November. But I want to play into what I believe is a correction. And if I'm wrong, then we'll sell a whole bunch of puts and we'll just scrape it back, right? Because the market's not going to move 10% in a week, but we can scrape it back. If you have a six-figure account and have the ability to sell put options, you have a lot more flexibility than people who have to go straight asset allocation because they can't use the puts. But selling puts is just a ton of money. There is no difference between fundamental trends and margin of safety. They're the same services right now. Now, eventually fundamental trends, because of the platform, is going to add a swing trading service probably by year end. So if you want to do more swing trading, you may have to migrate over to fundamental trends. But other than that, margin of safety is just fine. And generally, I publish on margin of safety first by a couple minutes. because I like their platform for writing. Although I am converting fundamental trends to WordPress, so I'll probably just go back and forth in the future because the WordPress platform is way better than what I'm using now. Sounds like nobody has an idea how to value a business and understand stock's intrinsic value. Well, I wouldn't say no idea. I mean, sounds like he has. I'm not sure who you're talking about. Who are you talking about, Travis? Sounds like he has no idea how to value business and understand what it's. Oh, that was probably somebody from on the board. I get it. Yeah. I remember. Going back in time, that was way back at 10, 12. Will oil service stocks and pipeline guys ever have their day? You would think so, right? Right now the exploration and production companies are the place to be. I like Helmerich Payne. They've had a correction off their top, right? And then we started buying in here. And I haven't sold. But look at this. They have this little cross coming up. If this doesn't bounce off of here, you probably exit, take your profits, and look for a lower buying price down around 50. But, you're splitting hairs almost. If you own Helmerich Payne, I don't think I'd be fudging with it too much. This is the one that really is leveraged to the fracking. They are the biggest land driller, and I'll say this: for folks who don't own Helmerich Payne, this is going to be a company you should look to own, because once the pipelines get built in the Permian and a couple other pipelines, but mainly the Permian pipelines, then you're going to see production jump up again, and they'll make money. So I think they're just in a short-term trough that'll last a couple quarters, and then the market will anticipate a rebound sometime early next year. So if you're a new buyer, I think you're looking for a place to buy in the 50s somewhere. If it gets all the way down to 50 or 48 or 47 again, maybe even buy leaps. But Helmerich Payne, very nice fat dividend. So if you already own it and you're up, even if you're about to round trip, I think, what just happened? Was I looking at the wrong chart? Oh no, I was looking at a longer term chart. Yeah. So here, you can look at the short term chart, right? Came off pretty good. So I don't know how much lower it can go. I really don't. Like I said, we bought it down in here. Could it round trip? It could. And then new buyers should be looking at it. But if you're an existing buyer, I don't know that I'd screw with it. AT&T continues to go sideways. Would you trim this holding to generate cash? Depends how much you have. I have what I want, and I'm going to keep it. If you somehow bought it to 7-8% of your portfolio, you bought too much, and trim it back to 2 to 4%. And you have to consider how much CenturyLink do you have? Do you have Verizon? Do you have the telecommunications ETF? You got to take a look at your asset allocation. So one thing to remember about telecom is they're about to get a big boost because of the new ETF in the communication sector that's going to bundle them with Google and Facebook, and that's going to be a pretty popular ETF, I think. So I think the telecoms get dragged up because of demand for that Spider ETF. What is it? XSC maybe? Spider SPDR Communications XLC. There it is. So this is going to replace the telecom ETF. Well, all right. And the holdings are Facebook, Alphabet, Activision, Electronic Arts, Walt Disney, which is back on my radar, Comcast, Verizon, Charter, AT&T, Netflix, right? So these companies that you think of as tech are now getting bundled in with the telecoms, and they've just created a communication sector. So they've revamped everything. And so the stocks that were in the tech ETFs or are in that tech ETFs, it's not going to affect them. But this ETF will generate some demand because Facebook and Apple or Alphabet are in there, and I think it's going to pull up our holdings, which are AT&T and CenturyLink primarily, but I have a little dab of Verizon as well. I have company stock and a bunch of index funds in my 401k. Currently, I have 40% cash in 401k. What is the best way to invest and protect the 401k? I think you did it. 40% cash. I think that's how you do it. I've been telling people to invest half of their contributions in their 401k internationally. So your current balance on a 401k and your contributions are different, right? So your current balance, I'm telling folks 25 to 40% in cash, but your contributions generally pick out 4 funds: large cap, small cap, international developed, international emerging, and that's what you're looking for. And just quarter, because you really need to understand that over the long term, international markets make more money than the U.S. market. It just is. Plus, remember, you're tied to America for your income and your real estate and your expenses. Yeah. So, okay. So just did the 401k. You can protect your assets with stop limits. Here's the thing. Stop limits have become much less effective in the last several years because it's something like 80 some odd percent of the market moves happen overnight. So basically, you just wake up and the market's up or down a whole bunch, right? So it's not like a flow through during the day where the stops could hit. You could just wake up in the morning and your stock is way below your stop limit and you're screwed, right? Because it just blew right through. So stop limits are less effective. The value of asset allocation is gigantic. So you really want to be preemptive and adjust your asset allocation. Natural gas market, you'd think that at some point it's going to do real well, right? And I've been saying it for years, and they just keep chopping along. Ultimately, and this has a lot to do with President Trump, ultimately I thought the gas market would have taken off already. But President Trump has added a support for coal, and that's going to have to be temporary because whether you believe it or not, we're changing the climate of the world. And there was just another scientific study that said it was like 5 in 1 million likely that we're not doing it. So that means 999,995 out of a million times what's going on with the planet, it has to do with us. That's a pretty high probability, right? So I do think natural gas will do well. I would be buying it on pullbacks. I like Chesapeake Energy. I still have my calls on that. Most of my calls on that. What hedging? I think I'm probably going to buy some S&P puts and some VIX calls if I can get good prices. Any thoughts on WHD? Not off the top of my head. Who is that? Who is WHD? WHD. Cactus. Is this what you mean? Cactus? I have no idea who that is. All right. If you want to clarify that, Treed, I'm not sure what WHED is, if that's correct. Yes, everybody gets the same stuff there. Acklock. Everybody gets the same stuff. EBVV is taking. No, now, I told everybody to sell AbbVie a while back. I don't like healthcare right now. Okay, so going back to the 401k. The simple way to do it, and this is the way that I tell people to do it, put 1/4 of your money into the best large cap growth fund, large cap fund in your 401k. Put 1/4 of your money, this is contributions. 1/4 of the contribution to large cap, 1/4 of the contribution to small cap, 1/4 of the contribution to international developed, 1/4 of the contribution to international emerging markets. Simple. That's the contribution. You leave that forever. Now, from time to time, you need to change your current asset allocation. So you might reduce, all those things to 1/4, but then proportionally pull out and put money in cash. So right now, I think having 40% in a money market account or cash account or stable value fund in your 401k makes sense, and then equally weighted the balance, the other 60%, equally weighted across those 4 other funds: large cap, small cap, international, emerging markets. Make sense? No, I own my CHK Leaps. I sold a little bit just to make it a next to free position. But in general, I'm riding those babies out. I don't plan to sell any of my 2020 Leaps until into early 2019 at the earliest. What I am actively doing is looking for spots to close out my 2019 January calls and Leaps. And I've been doing that over the last couple of weeks, as I've been discussing. And I think everybody should be doing that because you're running out of time value, right? So I don't think you need to roll those just yet. I just think you'll be able to get a new position down the road. All right. You could do mid cap, but in general, the small cap and large cap funds overlap in the mid cap. If you want to parse it out to large cap, small cap, and mid cap, fine. Just do them equally. 1/6, 1/6, 1/6. That's fine if you want to do that. Especially if you have a really dynamite mid cap fund, then go ahead and do that. Not all funds have that, but you could certainly do that on the 401k if you want to go, instead of a quarter to large cap and a quarter to small cap, you could go 1/6, 1/6, 1/6. Wellheads and pressure equipment. You used an acronym on me when I wasn't ready for an acronym. So in Texas, which is really what you got to pay attention to, you have the bottlenecks that are happening in the Permian, like right now, just starting right now. And so you have a lot of pressure on the services industry because they had to ramp up, and now all of a sudden they're going to see a little bit of softness in what was the fastest growing area, right? So how does that play out on earnings? It should mean softer earnings, maybe in the fourth quarter or first quarter of next year, and the market's already anticipating that. Because when you take a look at XES, which isn't the perfect fund for sure, but look at it. The darn thing just, you think with the rising price of oil, it would have gone up, and it just hasn't. Why? Because of the holdings. Some of these companies just aren't all that good. So if you pick out specific companies, you might have a shot. Oh, I see. I don't know anything about these guys. Where do they operate? Do they operate in the Permian? They must, right? Production trees. Yeah, I don't know. This one's a little bit over my head. I don't know anything about them. I'd have to take a look at their, there you go. I have to take a look at their website. Ooh, Christmas trees. All right, so here you go. Yeah, I don't know. You'd think that they have a bright future in general because of the natural gas, but I don't know anything about this company in particular. I don't know their financial position or anything like that. AOS. What is this? Somebody lean on their keyboard. AOS. Wish I could give you a better answer on Cactus. I don't know. A.L. Smith. Man, that's a blast from the past. That was a big deal in Milwaukee years and years ago. Yeah, I don't know. Let's see here. Debt to equity, pretty good. Free cash flow, $25 million into a $10 billion market cap. That's not particularly sexy, but they do pay a little dividend. Tear apart the business. If you really want to know about them, I don't know anything about their business. Tear about their business. I will say that it's a highly competitive industry, so I'm not so sure that they have much of a moat around their business. I could, they could chop along for a very long time. Technically speaking, you can take a look at these longer term trends. This is good. It's a good chart. That looks like an area where you could see, you can see some danger to go back down into this area in that 35 to 40 range. You have to take a look. This is not constructive, right? This is bad that the 50-day is moving over to the 200-day. So purely from a risk management standpoint, I would not have an oversized position in this, because this drop right here, that's bad. That usually means there's another drop coming. So you might see right down to 45 or something. So I would just be careful with that one. Ever look at AMSC? AMSC. I've heard of these guys. I don't know anything about them. That chart scares the bejesus out of me. And they're free cash flow negative. Hate that. Debt free. That's nice. Price to book is 2. Generally try to buy these type, rebound companies, which is what this must be. It's a good business to be in. Yeah, so they got the secular trend on their side. Wind power and power grid. Yeah, this is something to explore. Send some bullet points for me to take a look at, and then I'll break it apart. I mean, I eventually get to all this stuff. And what I'm looking for is asymmetric upside. Is this a company that could go bam, 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 and then suddenly grow, right? I don't know. Don't know anything about it. Kinder Morgan, love them, right? They're raising their dividend just like they said they would. The share price has been sideways trend bound, and I think it's the intermediate term is on their side, right? Could they pull back to 15, 16 again? Absolutely. Selling puts, I think that's a good way to get in. Or you just set a limit order and then you go fishing and wait for it to hit. That's who they are. They're thieves. Okay, I didn't know that. American Semiconductor, they're thieves. He says maybe they are. Who knows? I don't know. CF, I like CF. I don't like them as much as Nutrien, but CF plus Nutrien is a pretty good little mini basket, right? Because they do different things. So, in general, I like this company. I do. In general, I like this. So we just looked at a $10 billion company with $25 million of free cash flow, and then we look at CF with $214 million of free cash flow. Who do you like better? So I like CF. I like the fertilizer industry. Maybe it's because I garden, right? I do a pretty good garden, at least until this year. But again, understand my big thesis. I think that one of the big secular trends is climate change, and that a lot of things are going to do badly because of climate change, and other things are going to do well. I've been talking to several people. I think ultimately we solve the climate change issue over time, but there is going to be, we've done so much damage already that there's going to be this huge transition period. The planet won't fix itself in 2 years. It's going to take decades. So we have to stop hurting it first, which means getting rid of coal. And in the meantime, we still have to grow food, so the fertilizers will become important in a world where, until we recharge all the aquifers by building water desalination plants using solar power, which is what it's going to be. You want a futuristic view? You're going to see hundreds of desalination plants in the next 30 years that use solar power, and they recharge the aquifers with that water. That's coming. And it'll potentially thwart the rise of the ocean, right? There's huge monumental things coming in the next 30 years, but we have to get through this period of stupidity that we've decided to have right now. So there's an interview with Jeff Bezos that I just watched and I'll find it and I'll post it. It's a way of thinking, and it's amazing. All right, one more company, Mike. Oh, okay. I don't know the AMC story. Macri. Yeah. We put that on our radar, and I said when I put it on the radar over here, I said don't buy it because there could be a giant correction. We got the giant correction, and now it's rebounding off. I think it probably tests these lows again. So I'm not a buyer just yet, and I need to really tear apart. You want to learn about Macri, tear this apart. To go to their presentation, and tear it apart, right? Also, they have their 10K. Read this. I know everybody hates to read. Reading's hard, but the 10K. If you're going to invest in a company, honestly, you got to read the 10K. I know it's like reading a book. It'll take a day. Some of the stuff you won't understand. I don't understand at all. But it's worth doing. So, and then the shortcut is, right, take a look at the presentations. So this is a company that has some pretty interesting businesses. And you'd think over time they do really well. But you need to examine their financial structure, because a lot of these companies are financially engineered to the point where if interest rates go up, they are in big, big trouble. So did they already deal with that issue? Maybe. I haven't looked in a while. But that's what you're going to need to do. That's the question you have to ask is financially, are they good now? Right? And is the long-term trend in their favor? Are their business units all doing a good job? All right. Oh, the books. If you haven't read a Taleb book, I don't know if that's how you spell it. Right? If you haven't, just go read the Taleb books. Anti-Fragile, I think, is a good one. But they come in. So there you go. So they come in a set. If you want the set, just buy the set for $40. It's a good set. I have them all on Kindle now. I just started using Kindle, and I like it, and I don't like it because I like the paper and I like to be able to write notes. So Kindle's hard for me. I'm old. I'm getting old. Yeah, Black Swan is the one that you became real famous for. What's the title of the book about millennials? Oh, I don't know. There's a book. I think you mean The Fourth Turning, right? This isn't really about the millennials. It's just it talks about cycles of history, right? And the millennials should be a hero generation. The problem is that it's not the history of millennials. I mean, this goes back 2,000, 3,000 years. Just talks about the 4-generation cycle. There's 4 generations, archetypes that just keep repeating themselves, and it's been going on for a very long time. So, the fourth turning, there is a summary. I think it's just fourthturning.com. Yeah. So, what is a generation? Generational archetypes. It really just talks about what each type of generation is. The millennials are supposed to be a hero generation, right? Generation X is a nomad generation. Who do you know that's a Generation Xer that just likes to drive around the country? Yeah, that's me. They nailed it, man. And I'm an Aquarius, too. So I don't know what that means, but, So, all right. I'm going to let you go. This has gone over an hour again, and I'll probably cut off a bunch at the end. But have a great weekend. Look for things to sell. I'm going to work on some things to buy as hedges here in the next hour or two and get those published. and I will publish the this call. So if you didn't listen to the whole thing, you'll get this real quick. All right, take care. Have a wonderful weekend.